afternoon, everyone, and welcome to Stock Market Today. It's Coram and Justin Nielsen here with a breakdown of the action in today's session and a look at how the week panned out today, Friday, October 4th, where we saw a really nice, strong finish to the week, Justin.
Yeah, not bad at all. And look, it wasn't bad even earlier this week. I liked how things were holding up, but certainly a nice way to end, especially after that jobs report came out. And we've got some stocks to talk about as well. We'll stick with that insurance theme. I know it's something that we've been covering for a while here with Arch Capital Group. Also Reddit, which was breaking out today, and Shopify, something that I don't feel like we've talked about in a while, coming back on my radar.
Exactly. Okay. Well, a lot to get to, and it's Friday, so we're going to get your screen share as well, adding some additional technical perspective to the index action. So really looking forward to that as well, Justin. So let's get right to it. First, let's take a look at the major indexes and the daily performance. So the NASDAQ today closing up 1.2%, the S&P 500 up 0.9% on the day, the Dow up 0.8%, and the Russell 2000 leading the day with small caps snapping back here up 1.4%. And this was not a straightforward session. Like you said, we have the jobs report data and a strong open, but what a dramatic finish. We faded a lot, almost filled the gap completely, Justin, but came roaring back by the close. The NASDAQ closing basically at highs. I think the S&P 500 got to new highs, crossed the morning highs. So a bullish finish here. And almost it seems like arguably an ideal setup after a pullback to a level that we wanted. Stuff has been running. We got that, little mini shakeout reset, and now we're bouncing again.
Yeah, I really couldn't ask for anything better here. I mean, you got support where you wanted it, and the remaining question was, will you get a bounce, right? Because when you kind of go sideways for a little bit, you're always wondering, okay, is it going to be a breakout or a bust up and go the other way? And in this case, it does look like we got the bounce that we were looking for on the NASDAQ composite here. That support really came in right there at the 21-day moving average line. And I think we were really looking at that 18,000 level. Could we get above it? We did get above it yesterday, didn't hold it, but today it was a different story. And as you said, intraday, it was a lot of movement back and forth. So there was kind of a will it or won't it type situation, especially with how strong the market started. And if you did all of your buying very quickly, you were probably feeling a little bit uncertain as things pulled in quite dramatically. Almost, I don't think we ever went negative, but we basically were flat for a little while there. So that was something that was probably not that comfortable. But as you said, as the day went on, and especially in the last minutes, the last hour, it was a very strong finish to the day.
Absolutely. You know what also added to the drama today, Justin? If you wanna call it dramatic, look at the 10-year Treasury yield. I mean, what a spike here.
Yeah, I mean, absolutely. You can't deny that. And this is something that we've been watching for a while. So look, for the day, this was up a lot. This is still in a downtrend. So I think that is important to kind of remember. But maybe this is something where we have to talk a little bit about the jobs report and how that kind of changed things. And I would highly recommend that people, when you're trying to decipher what's happening on with some of these economic reports, to go to Jed Graham's stuff. He does an excellent job of breaking it down. I read his article this morning, and here are a couple of the things that I got from the jobs report from Jed Graham's article. Number one, blew estimates away. We were at 254,000 versus estimates of 132.5 thousand. The hiring gains for July and August were revised up. I did see some people. I think Jed had this in his article about this may be revised down later. That's what's been happening, and especially there was a lower response rate, so that might get revised down. But unemployment, that unexpectedly dipped. That was at 4.1% versus a 4.2% forecast, and this despite an increase in the labor force participation. Because again, you change that denominator with more people participating in the labor force. A lot of times that does have an effect, but not this time. even with the increased labor force participation, still unemployment came down and wage growth
Mhm.
was up. So who doesn't
Yeah.
like more wages, right?
Yeah.
4% versus a 3.7% forecast for the
Mhm.
12 months. So what caused the 10-year yield to spike higher? This is something that you might have been scratching your head on a little bit. And why was the Russell 2000 so strong if
Right.
the 10-year treasury yield was up higher? Because usually it's the opposite, right? When the yields are going up, borrowing costs for these smaller companies go up, and you would think it would be kind of the opposite way. So let's kind of break this down. One of the big things you have to look at, and this is something we talked about on IBD Live this morning, was the Fed futures. What is expected for this November 7th Fed meeting? um, 50 basis points, that was starting to get baked in. It was almost what, a 60% chance for a 50 basis rate cut. And while you might say, well, gosh, aren't rate cuts good? That stimulative effect. Well, but if they're doing 50 basis points each time, that's usually meaning, oh, something's broken. We've got a recession fears that are so high that we've got to do something. So one of the things that we saw recently is, even earlier this week, we saw that over 50% chance for a 50 basis point cut drop down to 30%. And now it's at zero. It was kind of like no chance. In fact, it shifted to a 99% chance of a 25 basis point cut and a 1% chance that there was no cut at all for November. So a very big shift. And that's why you saw those 10-year treasury yields
Mhm.
go up on that news.
Right. And then, so then that means if we need, more modest cuts from here on out, that means the economy is strong, but we're still, getting that tailwind of the cutting cycle, right, Justin?
Right, exactly. So it's kind of you're getting the best of both worlds. You're not in a panic mode where, oh my gosh, we really have to cut in a big way, kind of like what you saw after the dot-com bubble in 2000 or the great financial crisis in 2008. So it's not that kind of, oh, we really need to do something to stave off bad stuff. This is more like, hey, we're getting the soft landing that we wanted, and that's why you had the Russell 2000 doing well. You had a jobs report where unemployment's doing good. There more people are, working, their wages are growing, and that's good for the economy. More buying, that's better for those small companies that people are able to buy stuff than a recession and all of those things that come with it. So they'll take the higher interest rates for more buying from the consumer.
Yeah. Okay. Let's also talk about the VIX, Justin. What are you seeing here?
Well, certainly the August 5th, I mean, there were so many things to look at on that day that spiked that. And, let's just real quickly look at the monthly chart, because to put this in perspective, that move up to 65 was right up there with COVID, which was much, much higher to 85. That was up there with 2008, the great financial crisis, that was at 89. That was up there with a lot of these big, I mean, Volmageddon, for those of you that remember that in 2018, where
Yeah.
a lot of these volatility instruments just blew up. I mean, it was higher than that when we got up to 65. So, but it didn't stay there for
Mhm.
very long. It was just really a spike and then came right back down. And of course, you had the carry trade, the yen carry trade. You had Google antitrust. You had Blackwell and Nvidia, being delayed. All these different things. But we came down. Um, I had John Nigerian on the podcast this week, and I know he and his brother Pete, they often talk about, hey, when you start getting above 20 for the VIX, that's kind of giving you a sense of a little bit of elevated fear. Now, we of course saw that on August. We saw that to begin September when we had that really rough start, but then we came right back down. So I think people were maybe a little concerned that this volatility, this fear was getting elevated, but it's not like we don't have nothing to worry about. But the port strike, that kind of got resolved. The recession fears, a big one, that got resolved. I mean, we still have the Middle East tensions. We'll talk about oil in a little bit. We've
Mhm.
got the elections. So there's still things that are uncertain, but we've at least knocked some things out. And so that did put the VIX back below 20. So possibly a little bit less fear out there.
Yeah. All right. Well, speaking of oil, let's take a look. Here's USO, which is a proxy for it moves directionally with the price of oil. And a big week here, up about 8.7% or so. And then XLE, which tracks the energy sector. It's been a laggard pretty much all year, Justin, but a big pop this week, up 6.9%.
Yeah. And if you look at the daily chart, I mean, it looks like a pretty strong day for XLE. I mean, what's not to like there if you're long oil. But one of the things to kind of keep in mind is this was actually, in terms of the sector spider ETFs, the 11 sector spider ETFs, this was actually only in the middle range in terms of its performance today. It was not anywhere near the top. Part of that is, let's go ahead and look at the dollar. If you put in UUP, that kind of lets you know, oh, wow, we had a stronger dollar here. And when you have a stronger dollar, that does kind of dampen the effect. So look, the situation in the Middle East, a lot of people are fearful of if there's retaliatory strikes against Iran. Does some of that go after the oil infrastructure? What
Right.
is that going to do to oil prices? What is that going to do to supply? There's reasons to be concerned there. But the strong dollar did dampen some of the effects of some of those fears and some of that rise in
Mhm.
oil, since oil is priced in dollars.
Right. And I guess, Justin, the thing for traders to be thinking about here is, okay, is this a sustainable change in trend here for this sector, or is this more of a short lived phenomenon tied to what we're seeing with the Mideast fears rising now? And if things calm down, are we just going to see this group out of favor again?
Yeah, that's the $1 million question, and I don't have an answer, because there's a lot of uncertainty there. Really, it depends on what happens in the Middle East, and that's not something that's above my pay grade. I do not know what's going to happen there. So it's one of those things where if you're going into this trade, then you have to really be concerning yourself with, how do I manage my risk if things go the other way, if news comes out. And that's what's important with any trade, but especially with something that has so many variables involved with it, like the price of oil and gas.
Hmm. Okay. Well, Justin, before we get too far away from, what the indexes did this week and some of the major themes that we saw, why don't we provide an additional technical perspective on what we're seeing with the indexes with some regression channel work that you've done?
Yeah, so this I got to give credit to Webby here. So he's not here today, but he's going to be back next week. And this is the regression analysis. I'm using the settings that he uses because I think that they make a lot of sense. And right now he's been using the August 5th low as one anchor point. That was when all of that scary stuff was happening, that spike in the VIX. So using that as a low anchor point, and then you're just stretching it until today's activity. And so this white line is your regression line. We've got a 1 standard deviation red line, solid, and 1 standard deviation on the downside, green, solid. And then it's 0.75 on the dashed line here on the downside, and then a 0.5 standard deviation on the upside. So a little bit different there. And you can see we got very quickly above the red line. You would expect a pullback at that time, and that's exactly what we got. You did come down in September. That very sharp move to start September. You did cross below the green line, and that's not necessarily meaning that the trend is over or you're done. Just like this did not mean that the trend was way over by going above the red line. But you quickly snap back. And so that September 11th was a really important day because of
Yeah.
how strong the reversal was. And that's also when we saw a lot of stocks.
Mhm.
I'm looking at you, App Lovin, because that was one of the canaries in the coal mine in terms of how strong it was. And that one has not looked back. So a very nice move back into our trend, our regression channel lines. We came back up to the regression, that white line. Then we surpassed the dashed line on the upside. You would expect, again, for a pullback to happen, and that's what we did. But we held above the green line. I was actually kind of expecting maybe a touch at least. But this market really was resilient, didn't really want to come down, and that's what we saw here. So now we've got a strong move today, back above that white line. I would expect it either to kind of hang out here or potentially give that red dashed line another test. So right now, things are looking like it's trending very well in this regression channel line. And again, we got support exactly where we wanted to see it for both the S&P 500 and the NASDAQ. So I think that's a big positive as well. And yeah, when we go back to the market search charts, your market search charts, I think one other thing to note that Ed mentioned is that we're kind of looking at a 3 weeks tight on the indexes. That's not something that's a great look too. So if we can see more stocks that have taken a little pause and we're breaking out, I think that's just an extra positive, having kind of that tight action that we had right around 18,000. And so I'd really like to see us kind of get to new highs fairly quickly.
Well put, Justin, and the S&P 500 as well, showing tight action in addition to the NASDAQ. And we saw a lot of volatility in August and September. And it feels like, Justin, when you get these periods of volatility, it seems like that corresponds with some really tricky markets. But if you start seeing orderly, tight action, that's often associated with these trending markets. So that's what we want to see.
Yeah. And I would also add that this is, as much as we always kind of look at tech a lot, this is not just a tech-based rally. In fact, I would say tech is not even in the top three. There's a lot of other industries that have been really bringing these markets up. In fact, let's go ahead and take a look at RSP since we're on that subject, because RSP is arguably been stronger. It didn't come down as much. It did come down to those levels. It's closer to, its all-time highs. It's, it came down to the 21-day moving average line, but it really has been trending a lot nicer. And this, of course, is the equal weighted S&P 500 index. So when you take out some of that heavy weight of the mega caps, the $1 trillion companies, you can see that, breadth has been improving here a little bit. In fact, GMIAA, which is the NYSE, shows the NYSE advanced decline line. You can see that this has been in a much better uptrend than GMIAB, which is the NASDAQ, advanced decline line, which has been a lot more flat. So it's definitely outside of tech where a lot of strength has been gravitating.
It sure has. And I know I'm jumping around here a little bit. We looked at XLE. Let's take a look at some other sectors, Justin. You want to start with the worst performer and then work our way up from there?
Yeah, let's do that. So worst performer today, unfortunately that belonged to XLRE. And we've been talking about how real estate has been looking very strong, but look, and it wasn't, it wasn't horrible. It was down 0.6%, but on a day where everything is up so much, that feels a little wrong, right? So why would that be? Well, this goes back to our 10-year treasury yield. A lot of the action was coming from these lower rates, helping real estate, helping the home builders, potentially putting mortgage rates lower, all of those things. So yes, that did get hit today. And if we look at XHB, you can kind of see that was, looking a little weak today, again, especially considering how strong so many other sectors were. In the same vein, XLU, utilities, which have been on a really strong uptrend. I mean, this just does not look like how utilities normally look. And it hasn't just been because, we're in defense mode. I mean, with the indexes so close to highs, I would argue that, defense hasn't been the top priority for a lot of people. But of course, again, the 10-year yield going up, that does, a lot of these are dividend paying stocks. And so now you've got some competition with your dividend when you can just not put it in a stock and get a higher yield elsewhere. Moving on up, we had XLV healthcare that was basically flat. XLP, our consumer staples, was up a little bit, but again, you wouldn't expect this to be up a lot on a day so strong. People aren't going to be really getting defensive with the XLP staples, consumer staples, and healthcare. XLB, something that we've been watching because of all that stimulus in China, sending a lot of the copper plays and stimulus there. That held its own, up 0.5%. XLI, same thing, about up 0.7%. XLE, as we mentioned, that was right in the middle ground. So, right around exactly where the S&P 500 and RSP were. XLC, now we're getting in a little bit more on the tech side. So communications, that includes Meta and Google, that was up over 1%, as was XLK, the tech sector, which includes Microsoft and Nvidia in there. And then XLY, which, XLY, the consumer discretionary, Tesla is a big component here. Amazon is also a big component. So the fact that these two were up a lot, it's over 40% of XLY. But XLY looked pretty good. It just came down to the 21-day moving average line, which was right there at around 195, its previous high. So it again got support right where you'd like to see it. But the top sector today went to XLF. I feel like we should have done a drum roll maybe.
Yeah.
1.6% for XLF. And, you can certainly put that on some of the big heavyweights there that were getting above their 50-day moving average lines. JP Morgan, Wells Fargo, so that's JPM, WFC, Goldman Sachs, GS. Those were all getting back above their 50-day moving average lines. But if we kind of take a broader look at KRE, the regional banks, that was getting back up to its 50-day moving average line. KBE, also looking at the banks, that was getting above its 50-day moving average line. But I think one of the strongest areas of finance, KIE, haven't heard of that one? Insurance. Back to insurance. And it's also worth mentioning BRKB, Berkshire Hathaway, the B shares, that is also very heavily insurance. That had a 2% day today. So very, very strong action, which this has a lot of diversification, but very heavy in the insurance. And again, you saw insurance up 2% today. So
wow.
That's, again, you usually think of this as a very slow, pokey area. But insurance has been one of the best areas. It's been slow still, but in a very solid uptrend.
Slow and steady. Yeah.
Slow and steady.
Look at that outperformance over the last 2 months. Okay. That's a great transition to taking a look at Arch Capital.
See what we did there?
Yeah. ACGL. ACGL is the ticker here. A couple of weeks of tight action and up 1.3% on the week this week.
But look at that tight action that it just broke above. So here we have a stock that is crossing into new high ground. It had a flat base that it was coming out of. That flat base was only 9% deep. So for all of this, volatility that was happening in June and even at the beginning of August, this stayed at 9%. And then the September, how September started so ugly. It got support right there at the 21-day moving average line, got support there again just a few days ago, and then kind of rocketed up today. So there have been a number of names that we've been talking about on IBD Live. It's just a group that we keep on going back to because there's setups there, and we keep on. This is where we're letting the market kind of tell us. If you see a lot of stocks setting up in a certain area, that's something that's worth paying attention to. Also included in the insurance space, some others that we've talked about this week include Brown and Brown, BRO, which joined Leaderboard this week. I should also mention that KIE was already on Leaderboard previously, the insurance ETF that we talked about. Ryan was another broker that we talked about. I do have a position myself in Ryan Specialty Holdings. That's had a nice move. You could have been getting into that on the downtrend break that happened this week, something that we were talking about on IBD Live. So a lot of interesting players in there.
Yeah. Who would have thunk it? Utilities and insurance stock, right, Justin?
Yeah, beating up on the tech, the big tech stocks, right?
Yeah, yeah. Well, we're gonna highlight where the strength is.
Yeah.
So, uh,
And sometimes, you scratch your head and you wonder why, but I think a lot of times the answer to why becomes obvious
here,
later,
yeah.
but in the moment, the charts kind of give you that first impetus that, hey, something's happening. This deserves your attention. So to your point, Allie, if you focus on strength and where that strength is, where it's going, that really can help you keep on the right side of things.
It sure can. Let's go to Reddit now. An IPO from this spring. It's spent a little time working on a base. The depth here of the base, 37%. The handle, though, just 7% deep. So a very orderly handle here. And it really turned on the gas today with this breakout, Justin. We talked about it on IBD Live, and it looks like it. I meant to hit the daily. Yeah, it did not have the same
Yeah.
kind of pullback intraday that the indexes had. It was off to the races pretty much all day and closed up more than 7% with some volume behind the breakout.
Mhm. I do have to disclose, I do have a position in this. We had it on Swing Trader and unfortunately didn't give enough space. We got out on that bottom day. When it reversed, it looked ugly. It improved. We didn't wait until the end of the day. Arguably, this could have been bought on Wednesday if you didn't have it previously, and it was just something that I missed. I saw it and it was like, oh, there was still so much uncertainty. Kind of, do I want
Mhm.
to do I want to go for a higher ATR, a more volatile stock on Swing Trader? And so I did skip it, and I thought that was a good idea when it kind of faltered a little bit yesterday. But man, today, as you said, from that intraday chart, it popped up there. It really did not give anything back, unlike a lot of stocks intraday. And then once things started righting themselves with the indexes, this just kept on going. So a very powerful move. And again, something that, as you
Mhm.
mentioned, we were talking about this week on IBD Live.
We were. And one thing I want to flag for traders out there is to keep an eye now on the 75 level. So it closed today at 72.38. After a couple of days of the stock going public, hit an intraday peak right around 75. And then if you go to earlier this summer, right around that area too, hit a little bit
Mhm.
of resistance or turbulence, some of our friends might say. So keep an eye on that level. It would be really impressive if this stock can get above that potential resistance level and stay above it.
Yeah, so true. One of the things, keep in mind that this does have kind of a spotty earnings growth record, but you can see that the revenue has been accelerating. That revenue growth, looking very strong, going from 21%, 4 quarters ago to 25 to 48, 54. That revenue growth certainly going in the right direction. Again, a little bit more spotty. You can see that with the earnings line. So very, very whippy in that regard, but you've got some good sales growth that's looking good. And look, those are not small numbers. I mean, we're at the 200 million sales mark per quarter. So not small numbers that you're getting that spectacular double-digit growth from.
Yeah, not at all. Okay. And now let's take a look at Shopify, an enterprise software stock that, as you mentioned at the beginning of the show, Justin, it's been off of our radar for a while. Some messy action here. And from this spring or really February until a couple of weeks ago, a very deep base here, almost 50%, but it looks like it's righted itself. And after you see a deep correction with a lot of volatility, some gap downs, what you want to see is tight action. And that's exactly what this stock delivered over the last couple of weeks before popping out today, up 5.5%.
Yeah, a lot of times when something is trading below its 200-day or its 50-day moving average line, those are the red lines and the black line on the chart right here. I'm really not interested. However, when it can get above there, then I'm interested. Can it stay above there? And First, it did it with the 50-day moving average line. Then it got above the 200-day moving average line. And this just looks like it's getting comfortable there. Also, I think it's worth noting that there are folks that do like the golden cross, that golden crossover, which is when the 50-day crosses above the 200-day. You can use different different moving average lines, but that's one that a lot of people use. You're right on the verge of doing that. That's going to get some other people maybe interested in this stock. And so it had really tight action here, popped up today. This is something that we did put onto Swing Trader this morning, very early on, and added to it a little bit later as the strength continued. So this is, look, it had its moments, right? In 2022, it came down with a lot of the growth stocks, really ugly action, and that it still does have some overhead supply in that regard, but you can see that that's getting a little bit older now, a little less relevant, not irrelevant, now that we've crossed that 18-month mark that Allie's noted with the black line that we have on all market search charts. So it is getting older. It is above that 200-day, the 50-day, and while this base is very deep, the action recently seems like this is getting tighter. We are coming to an area of congestion from earlier this year. So right now it seems like it's on the verge of breaking through that, and we'll just have to see if that strength can continue and get back to at least the highs of this year.
Yeah. All right, Justin. Well, with all that being said, what should traders be thinking about this weekend to prepare for the week ahead? How should we be positioned at this market juncture?
Well, I think that we got the power trend that started not too long ago, and one of the first things that happened as soon as we got the power trend was we got this little pullback. So that might make you think, oh well, is it over? Not as long as we are staying above that 50-day moving average line, and in this case we even stayed above the 21-day moving average line for both the S&P 500 and the Nasdaq Composite. So when we do have that power trend, we want to be a little bit slower to necessarily get rid of our shares, especially for stocks that aren't doing anything wrong. But I also think that if you did kind of scale back a little bit, which I don't blame anyone for doing, you want to make sure that you have your watch list fresh and that you're ready to kind of start deploying that capital again. It might not be that you're looking at your typical growth areas. Again, there still seems to be a lot of breadth, a lot of areas that might be switching back and forth. We've seen some very fast rotations over this summer. July 11th, that CPI report was just one example of how things shifted so dramatically. And it has been faster rotations. So I think you have to be open to maybe more industries and sectors than you're used to, because that's where we've seen some of the growth coming from, some of those unexpected players. So do your homework this weekend, get your watch list all up to date and fresh, and be ready for the next week in case this strength continues.
Sounds great, Justin. Thank you so much for breaking all of that down for us today. And thanks to everyone for tuning in. That is it from us this week, but the fun continues Monday morning on IEBD Live, investors.com/IEBD Live for all the details on that. We will see you there. And then we'll also see you right back here Monday after the close.